Today is December 12th, and this is the ADM Investor Services Monday Morning Market Kickoff video. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, ADMIS's Vice President of Grain Research, and Alan Bush, the Senior Financial Economist at ADMIS. Alan, let's start with the financials this morning. On November 8th, Election Day, the stock index has plunged to 19-week lows, taking out a series of major support levels, only to recover all of those losses and close sharply higher by the end of the day. What is the technical rule of thumb concerning what a technician would call false breakouts?
Okay, in this case, when the market broke so hard, we took out a series of support areas. The charts appeared to give new sell signals, and yet support was found, prices recovered, and it actually closed higher on the day. So anytime, at least in this instance, there are a series of support areas taken out, futures can quickly come back. It has to be viewed as a sign of strength. So in this case, again, it worked very well, and as you know, we did see some new historical highs in all of the major indices, with this false breakout proving to be very important and a sign that higher prices are likely to be ahead.
Of course, fundamentally that night, you had an election, a big change in the U.S. How that also plays into a situation like this.
Right. Actually, it did. The feeling was that if Trump were to win, that it would be a negative on the economy. And then, for some reason, traders changed their mind and thought that there actually could be some positive consequences to a Republican wins. So that's change in thinking took place that day. So there were some fundamental reasons why we have recovered and advanced to these new historic highs.
How does uncertainty play into, a volatile market like we saw that night?
Okay, the rule of thumb is uncertainty means lower prices, and that would be another rule of thumb that could come into play. So uncertainty means lower prices, but that uncertainty seemed to only persist for several hours.
Let's talk about gold for a minute. After a strong rally earlier in the year, gold has come under some pressure. What is your outlook for gold now?
Well, the gold market has had some spectacular gains earlier in the year, but since July we have seen some pressure developing as traders focused mainly on tighter Fed, tighter credit, and a stronger U.S. dollar. Now, we do have the Fed meeting Tuesday and Wednesday, and it appears very likely that the Fed will raise rates at the second day of that meeting. So I think once that meeting is out of the way and the Fed does raise rates, which is the consensus view and is our view as well, that we will start to see gold prices recovering, and I think this will be a gain that will persist for the rest of this year and well into next year.
It's almost a certainty that the Fed will raise rates this week. The T-bonds recently made a 17-month low. Are we being set up for a sell the rumor and buy the fact situation when the Fed funds or the Fed raises interest rates on the 14th?
We could have been if the thought was that this is going to be the only rate increase, but that is not going to be the case. There are probably more rate increases yet to come. 1 to 2 I think are likely next year. So with more bearish news on the horizon in the form of additional tightenings of credit from the Fed, rising inflation levels, especially in commodity prices, and then soon to be in wage inflation, the main trend is still lower for the bonds. So I would expect any gains that we do see, any recovery gains along the way, are likely to be selling opportunities.
Steve, slow news in the grain markets. There was a USDA report last week. No change really in U.S. carryout. Anything out there to look at currently, weather in South America perhaps?
December supply and demand numbers are usually very quiet. There's not a lot of ammunition for them to make any changes. So it's not a big surprise that they didn't change the U.S. corn, soybean, or wheat carryouts. They did lower the soybean oil carryout because of the new mandates that may add more biofuel. Today, the president-elect tweeted about Taiwan and China, and not necessarily one China policy, but why don't we deal with them separately? And that caused maybe the bean market to break because the Chinese reacted obviously very negative to that tweet. And when we talk about trade wars, China's already said that they'll stop buying our beans if there's any tariffs put on their imports. So we have to kind of watch some of these appointees, and we have to see what happens in the Chinese-U.S. relationships. South American weather, Brazil's fine. The forecast is good for a record crop. That can offer some resistance to the marketplace. Argentina, about half of the country is dry. They're going to be dry for another week, but they keep showing in the 11 to 14 day maps some rain down there. So we really need some kind of weather problem down there to push beans and corn above resistance. And then the headlines in wheat is that they raised the Canada and Australia crops, and there's just too much wheat in the world for that market to rally.
If you're an end user of grain, is there some protection to be had at current price levels?
It's interesting in that probably for soybean oil, you're kind of past the price that you wish you had bought it, but it looks like that ultimately the stocks are going to be lower, so you probably want to get some ownership there. But if there's no South American weather problem, as an end user, you should wait for meal and wait for corn and wait for wheat for lower prices. On the other side of the coin, the farmers, every day the prices are down, are losing more revenue, and they have a lot of corn to sell. So there's been a lot of talk about farmers selling beans and selling corn and replacing it with a call, so that they just don't see any further lower prices in 2017.
Probably a smart strategy for the farmer. I know that one of the more well-read analysts is buying copper and corn. I understand the copper buying with the recent strength in the world economy. What about the buying of corn?
Well, I think that it's kind of like if you do it synthetically. Like he wants to sell a close to the money call on the May and buy 4 out of the money calls on the May. So basically, if nothing happens, you take the time decay out of the short call, and it pays for a free look at 4 calls for any uncertainty as far as weather in 2017. So it's kind of a speculative synthetic play to be long the corn market for 2017.
Yeah, a rather low risk trade with some decent upside potentials.
Yeah, because I don't think that the strike prices he's using to sell in the May the 360, I don't think we trade below that. It's just the farmer won't sell anything below that. So there's always risk in being short premium, but that's a good speculative play to synthetically to be long corn if there's a weather problem next year.
You throw a question out to the two of you. What about crude oil? It looks like the OPEC nations come to an agreement. Crude up strong today. Do you think that the recent rally in crude will continue, and where might we see some resistance in the crude oil market?
Well, I think 2 things. I think some people feel that the commodity markets got excited with the new administration, the threat of inflation, and you see some analysts saying we may be a little overbought and that we need to see some kind of correction, but if there is a correction, you should buy it. OPEC is talking like they want crude to go to at least $60 a barrel. They came out with an agreement today, not only the OPEC, but non-OPEC countries to reduce production. And that's why crude's up $2 a barrel. So on one hand, we're overbought. You'd like to see a correction, but on the other hand, it's probably something you should buy on a correction.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about the brokerage services offered at ADMIS or would like to open a trading account, please visit www.admis.com.